So sorry, I have taught you about VIX, and VIX will give you the depth, how much depth it will create in a month. Then I have taken you across to the next part, wherein 8 different variations of calendar spread I have told you, other than your credit and debit calendar spreads. In that, this particular calendar spread I have mentioned you in that group. So this is a calendar spread need to be taken. Objective should be consolidation or slight upward bias. So what happened here? We have post initiating that there is a deep correction. However, this particular calendar spread we have landed in a very small profit instead of a loss. Few hundreds it has come. So then that post that correction of a deep correction. In fact, again I have told you there is a deep correction very quickly happened. So I have told you another alternative wherein credit calendar with debit calendar we have taken with respect to this study. So how this strikes is being selected. So if you look into the VIX reading, you can understand why these strikes are being selected. So these two alternatives are given to you, and these two alternatives also you have worked on that. So today you are going to learn about bull and bear spread, and along with that also you are going to learn the Z-score related spread. So these two things you are going to learn today. Today's session we will be discussing about that. And Z-score is one of the best method for pair trade, and it is a flawless method. It can give you a great success if you can implement. Sometime implementation also go wrong. However, you have the capacity in that trade to correct that wrong. So that is very important. So sometime when you initiate, you hedge specific position which may require some more time value taken or anything taken. So that can be adjusted, that can be made. So this is what also a part of Z-score trades. So here couple of Z-scores you can say. Now NSG is telling that how the Z-score positions what is being initiated is performing. So this is being initiated, and you can say here a couple of profit bookings also is being taken out here. So taken out here, and that is a bigger lots, 19 lots, 13 lots. So it has just entered to the profit. So here you can say this one is 84.73, 10,000 profit it has entered, and it will go to a higher profit also. If another 100-200 point move Nifty, then that also will go to a good profit. So here Z-score gives you a chance to make bigger money in the market, provided it is not that simple to implement. It requires little bit of more homework from your end. You need to work a lot for Z-score, because when you are implementing Z-score related positions, you need to hedge it. That hedging part purely depend upon your expertise or your understanding on the subject of hedging. Is options is required, because without option hedging it is very difficult to make money in the Z-score. So that kind of capacity Z-score has. So that things you are going to learn. So those understand. So fine. So to start with the session, here bull bear spread. So mainly when we say it is a bull call spread, we are buying a lower strike call, bull call spread. Lower strike call will be buying, one higher strike call will be selling. So this action will be sell, and this action will be buy. It will result some debits from your hand, and that debit is your maximum loss. And whatever, if the my price goes up beyond high, then you make the profit. So this is a vertical spread, and bull spread is a bull call spread or bear put spread is a horizontal spread, not vertical spread. So vertical, so that is, let it clear it also, that is also a confusions coming in the mind. So here vertical spreads uh, are price spread. So vertical spread, this is a bull call spread, and bear put spreads are vertical spreads. So here what happens when we talk about bull call spread or bear put spread, who is the contributor? Delta is the contributor of the profit. So here if price goes up only we will make money, price fall only will make money. So here bull call spread makes money when the underlying asset price move up. Bear call spread makes money when the underlying asset fall. So here, so by nature, if you see, it is having a delta is the contributor. So as I said to you, when the delta is the contributor, we have to keep the delta at a 30% level. So 30% level, if we will keep it, then only it will make profit, plus or minus 30%. So that is what the delta says. So like theta says that 5 rupees, delta also maintains a 30 rupees, so 30%, then only that strategy will go into profit. So here two, three different ways we can implement this strategy. So when we are dealing with bull call spread, normally the book says to make it neutral, make it neutral, take a bull call spread, also take a bear put spread. So bear put spread and bull call spread both will make it neutral. But if bull call spread is being taken and bear put spread is being taken together, and there is a consolidation happen in the market, then that strategy enter into loss. So most preferably bull call spread and bear put spreads, you can say, that doesn't work. So when we take such kind of conditions and there is a consolidation happen couple of days, we do not make any money out of that. So that is a big drawback of that kind of setups what the most of the option books suggest. So how to make it then? So here our job is to make these things, we need to bring the delta to 30%. So if you understand delta, then you can do any kind of adjustment pre or post, bring it to 30%. But if you do not understand delta, how you can do? So you can do it in a different way. How you can do it in a different way? Form a bull call spread in Nifty 200-point depth. Risk reward must be equal, 1:1. Risk reward will be there. Then you need to form a bear call spread in such a way that, so here bear call spread, you must be, call strike must be higher than the sell call strike, bull call, and it must from the near month strikes, is not, must not be from the current month. So one bull call spread you are forming, one bear call spread you are forming, bull call spread you are forming in the current month, and bear call spread you are forming in the near month. And near month in such a way you are forming, their depth is 100 points. So here the depth should be 100 point, here depth should be 200 point. So here we want that some quick move should give us the profit, and this bear call spread should be half, means if it is 300 point you have taken 150 here, 400 point bull call you have taken, then bear call should be 200 points. So half of this point you are taking. But the most important factor is the bear call spread try to take a credit which covers minimum 115% of the risk involved in the bull call spread. That is very important. 115% of risk cover in the bull call spread, that should be the things you should take, then only it will become profitable. So see example, so then only you can understand. So here we are having two components. One is a bull call spread, another is a bear call spread. But we are taking in such a way that that profit, sorry, that credit should be covering of 115% of the risk which we have in the bull call spread. So here that makes it neutral. So here market goes up, we make a bigger money. Market corrects, we will make a smaller money. But here it is a non-directional strategy. You can say direction is in favor of trend, you can make a good money. Direction is not in favor, you make a smaller money because risk from more than the risk you have taken. So as a credit. So here you can see here one buying of Nifty is at 19,000. Sorry, 18,487. Nearest strike I am going 18,500, just at the money or just out of money you can say, and 18,700 call I am selling. So by this process what I am getting, so this if you can take a difference, so 5 5 0, so 0 50 paisa, then it goes to 4 13, and here 6, so you can say there is a difference of 6 here. So 3 3s are 0, and so 2 1 are 1, so you can say 106 point is the risk and only 94 rupees as the reward. So here 50-50 we may not get it, so slightly difference you can get, 4-5 rupees will come, or 10 rupees you can allow, but not more than 10 rupees. So 106 rupees is the risk, 94 rupees is the reward. So 106 rupees is the risk, so we want 115% of 106, so 115, and here 9 you can say 121 we want as a credit. So this is the risk. So to counter this risk, what we want? We want a credit of 121 rupees. How much we want? 121 rupees or 122 rupees. How much? So it is 115% of risk. So this is very important, because here if you compromise you won't get it. So 115% minimum. Maximum you can go for 150%, and that too again it says that the buy strike whatever you are having, the strike what you will sell, it should be above 18,700 strike, it should not be below 18,700 strike. So that also is there. You cannot get any strike which is below 18,700 to get this 115% of credit. So what you have to do then? You have to such kind of strikes to get in the current month, it is not possible. So we will be going for the near month. If we are in the June we are forming, July we will find out some strike which can give us 115%, and that too also will be hedged. If here it is 200 points, there we need to be hedged with 100 points. 100 points half. If it is 300, it is 150. Here 400, here 200. So we have to hedge, and also we have to make in such a way that it should cover 115%. So by this process I got 19,000 call July on the same day to sell, and 19,100 call I bought. So by this process how much you have got? 2, and here 4 2s are 2, 120 21 rupees and 90 paisa we are getting. So this combination is meeting our criteria. We have a risk of 106 and risk of 106, and we have countered. So this is only a hedging component, 19,100. So if we go for July, what will happen? Cost of that will be more, so we cannot get it. So our main aim is to get the credit of 115%. That should be the first criteria of us. So if it is and 115 to 150, it is not that only you should get 115, you should go slightly more also. So 120 125 if you are getting also okay, but not beyond 150. Why it is? If you maintain or if you make like this, it automatically make this strategy as delta as 30%. So delta 30% means it is going to give you the profitability. So less than 30% of delta, you may not get the profit. So by this process, if you can see here, small profit, small loss, small profit, small loss, it has come. In between, what happened? Market from 18,400, it has gone to 18,800 level. That is 18,800 level corrected. So this process was continuing. You can say that more major contributions of the losses was coming from here, the sell side of 19,000 call option. However, you can say that once that move was 18,700 above, and that consolidation takes place, so you have entered into the profit. You have entered into the profit. What more we can, how we can able to improvise this? Any idea how we can improvise this? So this is just a raw thing we have taken. This is the rule. Based on this rule, these strikes we have selected, and we have initiated these things. Just think a while. Using the VIX based system, is there any, because we understood that it is uptrend, if it is going, it is good for us, and after uptrend, if it is consolidating, it is good for us. So that is the situation. It is giving you the profit, and after that also, if there is a deep correction also, it will give, because 115% we have taken a credit, we are going to get the profit. So what should be the ideal situation we should initiate based on the VIX? So based on the VIX, if you are going to initiate it, based on the VIX, first identify the total price point of oscillation, 590, 600, whatever the depth of the market for that particular month, which you can able to make in the first day you are going to understand that. So put we are not using here. There is no need of put here, because here the, again, if you are going to the put, so what happens? That will make the situations different. So here what happens? Put is a different combination we'll take. We will not take the uh, put separately. We are taking here put also, we have a separate combination. So here we are taking only calls, and that too, one is a debit call spread, another is a credit call spread. Debit call spread risk reward is almost equal, and credit call spread covers 115% of the risk what is there in the debit call spread. So that is the logic behind it, but you have to take minimum 115%. So that you have to keep in mind. Credit should not be less than 115 points. So we got some places profit, some places less, smaller losses. Like this way we have got it. What will be the ideal thing we should take? How we should initiate this strategy? So the ideal way is when Nifty gives a uptrend. So say VIX based system said that it is a 600 point depth it will create. So we are taking 0.382. So it is almost 220 or 240 point plus it will create a uptrend. So where this uptrend, when this uptrend is being made, that particular strike near to the uptrend, that particular strike need to be bought. Where the trend is 100% achieving that top, that strike should be sold. Once you do that, then you next month you can hunt for something which is much above that strike to get 115% credit. 115% credit. So 115% credit. So that process if you follow, what will happen? Once this 240 point of plus it gives, then you need to initiate this strategy. Nearest strike, whatever comes that time, debit call spread will be initiated. But depth should not be 200 point, depth may be different. So depth will be, you can say that you will be buying near to that. If it is a 800 point, out of 240 is there, so there is a 600 point depth is there, so you can take a depth of 600 points. So whatever the risk reward comes, so risk reward should be equal. So based on that also, you have to 200 point, 300 point, 400 point, you decide how much bull spread should have a depth, so that your risk reward should be equal, 1:1. So that risk should be compensated with a credit call spread. So call should go with the call. So there is no role of put here. Puts will go with a put separately. So here why I am telling call should go with call only, put should go with put only. There is a logic behind it. It is not that simply I am telling that why you should take a call along with the call, put along with the put. Why I cannot mix call and put, because I have seen in many books you have seen that we can say that a debit call spread will take, debit put spread will take, will make money. But normally it doesn't result that. Why it happens? So that the it has a it has a great meaning behind that. So this is the fine print of your option chain will give you that idea. Why these things we used to take? Why I used to say that bull spread when you form call, you actually we are forming a bull spread and you are forming by that 115% of your credit, you are making it, or that 115% of credit is your adjustment, pre-adjustment. So devil lies in your option chain. What option chain says? So you can say option chain. Why I said that do not mix the calls with the puts? The reason is IV. See the IV here. All call option IVs, how much? All put option IVs, how much? Though mathematically by taking calls and puts you can make delta 0, but the behaviors will be different. Calls will behave differently, puts will differently, because their IV is different, implied volatility is different. But when you take only calls with the calls, you can say that that difference will not be that wide. Here you have taken a bull call spread. So if you go for the August we are taking, I am taking for September. So September also you will be saying that September once you are going that. So 6 to 8. But it is not the 6 to 11. So which is more comfortable? 6.5 to 8 is more comfortable, or 6.8 to year 31st August positions you are taking. 31st August position it is 6.5, 6.8. So we will be getting 7. So 7 and 8 is more compatible, or 7 and 11 is more compatible. 7 and 8 is more compatible. So that is why whenever you form a bull call spread with bear put spread, normally that strategy give you failures. The reason why? Because bear put spreads will differently behave. It has a different VIX parameter. Bull call spread will behave differently. It has a different VIX, the different IV parameter. So IVs of the call and put options are not equal. Most of the time the put IVs will be more than the call IVs. Put IVs are more than the call IVs suggests that uptrend is good. If call IVs are more than the put IVs, downtrend is predominated. That is the theoretical knowledge. Call IVs more than the put IVs in current month, call IVs are more than put IVs. That says downtrend is predominant. Put IVs are greater than the call IVs, uptrend is predominant. Both IVs are equal, market is indecisive. That is one thing you have to make it. And call IVs and put IVs, if they maintains 30% difference, if it is one is 10, another is 13, call IV, these are all practical knowledges. By 30%, if the call IVs are 10 and put IVs are 13, 30% difference it maintains, then it is an ideal situation. You can make some intraday buying things. If you buy based on the trend, if you buy the options, you can get success. If the call IVs and put IVs, it is not, you can take average out, you can take nearest 5 call, nearest 5 put. If they do not maintain a 30% difference, buying of options looking at the trend parameter will not be beneficial, because theta decay will accelerate in that case. Keep it in writing. So though this is not the scope of this session, However, I told you entire things of options. Call IV is put IV. If they maintain 30% difference between each other, intraday buying, looking at the trend is acceptable. As a trading instrument, you can consider. They do not maintain 30% difference, it is not to be considered. Nearest 5 strike, one at the money, 2 in the money, 1 out of money, you can take like this. Nearest 4-5 strikes. So not one strike you don't decide. So nearest 4-5 strikes, you can say that these are observations only. So you can say 19,500, 600, 600, 700. So 400, you can take this order. So here call IVs and put IVs maintaining 30% difference. That means there is a intraday scope is there. Theta will not be predominated. You can still have the chances to buy the options by looking at the trend. If they do not maintain 30%, that they don't touch purchase of options. It will backfire. Theta decay will kill your position. You will be expecting it will go up by 5 rupees, it will go up by 2 rupees. Theta decay will be predominated on that day. Equal call IVs and put IVs, mostly in the stock options during the result time it is equal. So once it is equal, what will happen? It is indecisive. Indecisive. Thus a trader doesn't know where it is going to be. So SBI result was expected. So you can see here SBI result was expected on Saturday. This is the Friday value. When the result comes, you will see here what is the difference. So 25, almost equal, almost equal. So this is IVs. IVs are equal, mostly during the result time. That time traders are indecisive. So equal IVs, that is not the time to purchase the options. These finest mistakes most of the traders used to do. Buying of underlying assets, buying of the options should be avoided at this time at any cost. Selling of options also avoided at this time any cost. Reason, because this is indecisive market. So you cannot say where the stock is going to swing. So this nature will go off tomorrow. Once Monday market opens, you will see the difference. The IVs will pre-adjust based on the price actions. So here, when calls are having higher IV as compared to put, that is seller's market. When puts are having the higher IV with respect to the call, it is buyer's market. Difference between the IVs maintains 30%, then either call is more or put is more, that time buying of options are advisable. That doesn't maintain 30%, selling of options is advisable. You can sell, 30% doesn't maintain, but difference is there. But if they're equal, neither buy nor sell. Understood this? And again I am telling why I used to always focus and tell you, watch out these particular videos again and again. These stops you'll never get in any book other than Smart Finance, these programs. Those who have come for this program only, they knew about this. Year long they are knowing it. It is not now. So it is not now. Year long period they knew it. So this is also a part we have to take it very carefully. Those who are all old participants, can anyone will tell me on the put call ratio what I said? How much put call ratio will give you of trend view? Trend will be up, and how much put call ratio can give you a downtrend view? That too also not volume based put call ratio, open interest based put call ratio. Those who are old participants, can anyone will tell me? 1.16. Saurabhji, 0.85 downtrend, 1.16. So put call ratio, book says put divided by call. So this is divided by this. Number of put contracts divided by number of call contracts. There are two ways you can find out the put call ratio. And one foolish way also is there to find out the put call ratio. That is, many illiterates are putting that things that has no validations. Many illiterates, those who have zero subject knowledge, they also put on put call ratio. I'll tell you that. So whenever you look into this option chain, you have open interest, you have change in open interest, also you have volume of contract traded. Put call ratio as per the options real arithmetic goes with the open interest. Put open interest divided by call open interest. If it is 1.16 above 168, I used to say monthly option only, not weekly. 1 point greater than 1.168, market will never fall. All fall will be absorbed and it will go up. Maintains 1.168, market will never fall. Keep it in writing for Nifty. Only for Nifty, not for stock or not for Bank Nifty. If it is below 0.85, open interest based 0.85, that particular day or that particular month, market will never go up. So that is also can happen. Sometimes currently it is at 1.18, Surajji is telling. So this is 1.18. It can go for 1.3 also. 1.3, 1.35 from here, one correction you can find. When it goes to 1.3, 1.35, small correction will come to drip it below 1.18, 1.18, 1.16, it will bring it. It's which open interest, which put call ratio, that is very important. Open interest based or volume based? Open interest based. Then comes to volume based. Volume based open interest also is there. The day you will find out it maintains above 1 or goes immediately above 1, whatever trend is there, that will remain. Keep it in writing. This volume based open interest, put minus call you will be making, and it will be going on switching. One point of time it will go above 1. The moment it goes above 1, whatever, if it is downtrend is there, that will maintain. Same downtrend, negative closing will happen that day. If it is positive is there, positive closing is going to happen. So that is not, trend is not going to surrender and back. That is two. One is volume based, one is open interest based. And what is there? One foolish base also there. Some fellows, so you can say that they are not even graduates, not even undergraduates, not even gone to the school, 10th, 12th fail. In all channels of YouTube, all are coming. So we'll make you a champion in options. What they are finding out, these two things they are adding, volume and this. Both you are adding and taking that things. That is a foolish option of open interest or put call ratio. Don't do it. Why? This volume what has generated, these are traded contracts. Traded contracts means somebody has bought, sold, it is closed. This is closed contracts. It has nothing to do with the open contracts. Only the open contracts will be there in the open interest. So whatever volume it has generated, that is not in the open contracts. It is closed contracts. It has resulted the windings, means that positions are closed, that positions opened for a purpose, intraday or anything, it has closed. That has contributed towards the volume. So it has nothing, no role in the open interest. Even though if you say that that is not closed and it is there, it is already there in the open interest. If you add it up, it is double getting added. Even though if you say no, yes, we are saying that this volume also, a part of this volume also is there in this open interest. It is well and good, because if it is already there, by adding it you are doubling it off, so that itself is wrong. So volume based open interest is a different thing, and open interest based put call ratio is a different thing. Market to go up, not put call ratio says that. Put call ratio says that. VIX based study says that yes, this is your expectations that there will be uptrend till 700 or 800. So VIX based yesterday we have discussed. So these are the things I have told you. Why, though it is out of the subject, the subject was not listed for your program. So here I told you bull call spread, why it should be adjusted with a bear call spread. That is very important. If it is adjusted, pre-adjustment happened, how much credit you have to take, that is also very important. Why bull call spread should not be adjusted with a bear put spread? Because IVs of that two things are different. Calls having a different IVs, puts are having different IVs. Though forcibly you can make it as a delta neutral, but that neutralness will not work out, because IVs are different. Once IVs are different, their behaviors will be different. Though delta, vega, all these calculations are their numbers only. They won't tell you, but their behaviors will be different. So more delta, more IV, more theta. So theta, so their decay in theta will be more, rise in theta also will be more. More IV is there, so vega also predominated, more dominations of vega will come. So these are the things mathematically, though it will say I am delta neutral, but it won't behave like delta neutral. So for that, do not mix the calls with the puts. Calls should be separately being done. Puts should be separately handled with the put. So that is how, if you do that, then this strategy makes profit. So you have seen here there is a small profit, small loss. It was going on coming. So finally it has given a profit. So now similar thing, if you are going to do it in the bear spread, this is pre-adjustment. Pre-adjustment. If you want to do a post-adjustment, so what you have to do? Initiate this particular first part. Initiate this first part. Trend should be clear. You should wait for a day and let it enter to a small profit. Once do not make it in the losses. Once you should initiate in a uptrend clarity market, when the uptrend clarity given 0.382 or intraday and uptrend clarity also given, one bull call spread you initiate, enter to a small profit, then you form it. Stage entry it will happen, so that also is advisable. Post adjustment. So those who do not want to make a post adjustment, that they want a comfort, they want a bigger position, 1-2 lot position, you can wait. If you have 100 lots, 500 lots, then do a pre-adjustment and complete the job at a stretch. Now next part, bull and bear spread options in the put and that tool adjustment. So here the rules will slightly define or change. Entry rules will change. Here what will be there? Spread difference will be 300 point gap. Why? IVs are different. Put IVs are more, mostly as compared to the call IVs. Risk reward must be 1 to 1 is to 1.5. Earlier what was there? 1 is to 1. It was there. The bull put spread, sell put strike must be lower than the sell put strike of this thing. That same rule is playing here. So half of the credit things it will be there. Cover minimum 100% there, 115% was there. Here I reduced by 15% to 100%. So by and strictly not more than 150%. So these particular things initiate in a near and far month for better result when Nifty is at a deep premium. That is also fifth rule plays on here. If you want to this particular strategies to work, do not go for the current thing, go for near and far. Reason is what? Nifty is at a deep premium. So near and far month you will get it as a very cheaper price. So once you waiting period slightly more, but reward will be better. So these are the small changes come here, and these changes are because of its higher because of its higher IV. So you can see it here. So this is, I have taken 18,000, 18,200, same 200 point gap, but 1 is to 1.5 risk reward it maintains. So 70 point is the, you can say, risk, 130 point is the reward, and whatever 70 point is there, so we are taking it here near to 75 rupees. We are taking 100% we are taking as a credit. So by this process, if you see, this has given initial period there was a few hundreds of losses. When it was correcting, then it stabilized, gone up, so we made a good profit here. This is also deep downtrend, it will give you a profit. After deep downtrend, if that is moving up also, it will give profit. And instead of January and February, we have taken it in the Jan and February, or in the month of January. If you take in the for the February and March, the result will be slightly better. So when should we exit this strategy? You tell me, Nabinji. Exiting of a strategy requires 1.5% to 2%. 1.5% to 2% gain on the employed capital. Whatever the capital if you have employed, in that 1.5% to 2%, if you get the profit, you can come out. So this is 1.5% to 2%, you can come out. So there is any strategy you take, it is not for this strategy, all strategy together. So same process also you can follow for the losses. If that much of losses has come and unfortunately you have not made any adjustment, that time also you should come out. Employed capital, employed capital is whatever I am saying, it is your capital. Suppose by the process of some box spread you got a credit, your capital is 5,000 only there, so you don't exit it as at 100 rupees profit. So if it has taken a margin of 1 lakh, at least 2,000 rupees you should give. And after that, if you dip into that, it is a spread, you know that maximum how much profit it will give. If you think that okay, it is still more scope is there for profit, you can readjustment you can do, means readjustment you can do. So you can pull it off this loss making part, put it some adjustment you can do, and wait for a higher profit also. So higher profit also you can wait for and come out. So this is how you should do the bull call spread and bear call put spread. And very important factor you have to see here, profit capping you can do. If you want to do it, if there is a scope of for getting more profit, you can do a capping, or you can come out with 1.52%. If you do not want to crowd your brain with so much of studies and work, you can, once you achieve that 1.52, you can come out. This other scope will open up there. So that doesn't mean that that is the end of road. So there is other scope also will be opening up, that similar strategy you can. So there are different ways, but the ideal choice is 1.5% to 2% if you are getting come out on the employed capital. Now we'll move to the next part, very important part, Z score. Looks very simple. Sometimes with little effort it gives money, sometimes it will test your patience and you need to wait. So which is happening from the June, July. So May 23rd we have initiated, those who are the guided program, those who have joined, the new May 23rd we have joined, we have initiated. June completely we have waited, so did not get anything. So July we got, but the hedging cost is more. July, because of RBI review is on the 8th of August. So we got more hedging cost. So here small adjustments we have gone, keep on doing on that, and some profit also has come as per the non-SGC study. This is maybe my positions what I have shown. So it is, we can say 510 quantity of Bank Nifty is there, 1150 is there, such a huge quantities. Still the, it was in the negative and it has just entered to the positive, just enter, and it will go to the positive in a great positive once going to Nifty goes to 19,700 or 19,750 level. So once it goes there, it will go into the deep positive. Fine. So that is the, and it has a great scope. And normally Z score, beta decoupling, this kind of methods having the scopes to double of your money. It can develop. So that scope is there. Scope is that much means work also that much will be there. Scope is that much means I will not study, I will not do anything, it will automatically make. It will never make automatically. Automatically market never makes anything. Markets make anything only automatically means in mind you can make, but it will reality it will never make. What is Z score? Z score is a mathematical parameter which gives you the demand and supply imbalance. Repeat, demand and supply imbalance at a particular time. So this demand and supply, if you take 30 days period, it is monthly imbalance. If you take 10 days period, you can say it is weekly imbalance. So demand and supply imbalance will create. And Z score, you have -2, one need to buy independent and sell dependent. Who is independent? With whom you are evaluating. If you are taking Nifty and Reliance, Nifty is independent because Reliance go to zero, Nifty will not die down to zero. So you can say index having 50 children's. So index is independent, Reliance is dependent. Similar way, when you go for the Bank Nifty and Nifty, Nifty is always independent because it is a cross sector investment. Bank Nifty is a single sector, so it is dependent. Z score -2 and +2 is our entry points. That doesn't mean that it is -2, it will sit there. It may go -3, -4, but historically it has not gone. I have given you a long list of Excel's workings. There you can find it out. So here negative, need to buy independent, sell dependent. Positive, need to sell independent, buy dependent. So this +2 -2, you can say, you can also form debit bull call spread, bear put spread also you can form. So how this Z score is calculated? Z score, first we have to normalize the data because Z score to calculate it will take only one parameter. Z score doesn't have the scope to accommodate two parameters. Only one parameter it has to take. Data normalization should happen because the data what we'll be using, it will be neither Nifty data nor Bank Nifty data. It is the mix of Nifty and Bank Nifty data. So first we have to normalize the data, find out the spread. So for spread, this is the formula. So then we have to calculate 10 days average spread, 10 days data standard deviations, standard deviation of 10 days, then 10th day Z score calculated on 10th day spread minus 10 days average spread divided by 10th day standard deviation. And if you want, we can take a correlation also. So here the Excel sheet also I have provided to you and already given in the group the updated one. So this Excel sheet I have created from 2019 to till date. Which year? 2019 1st January to till date. So what happened here? First we are calculating spread because it will not consider Nifty and Bank Nifty. Z score required only one entity. So Nifty will be independent, Bank Nifty will be dependent, spread calculated. Then here we have calculated average spread. So 10 units of spread, whatever trading date, all anything comes, that average spread we have calculated. Then we have calculated the standard deviation. Standard deviation of the spread. Standard deviation of the spread. Also we have calculated. So fine. So after calculating the standard deviation of spread and average spread, what we are finding out? Z score. So Z score is nothing but the actual spread minus average spread divided by standard deviation of the spread, that is known as Z score. So Z score will be every day basis, it will be going on changing. So you can say averages will change, but this part spread will not change. Spread will be taking only the latest data. So latest data, how it is deviating from the average data, what is the standard deviation of the average data. So based on that, Z score every day basis will change. The moment it goes to +2 or -2, our trade opportunity creates. So here 2.5 positive. So 2.5 positive means buy dependent, sell independent. So Bank Nifty is dependent. We are buying Bank Nifty, selling Nifty. You take the all values equal also. So equal values you can take. How much you are buying, that much you sell. So this plus 2.5 change it has come to negative here. Negative it has come. So if you will see here, negative, negative. So you can say here we have bought Bank Nifty and sold Nifty. So Nifty sold. So Nifty sold. So this is the loss in the Nifty. So how much loss? 25,000. And how much profit will be in the Bank Nifty? So Bank Nifty we have bought. So how much profit in the Bank Nifty? So that is 38. So this total of addition of these things is coming to 13,000 profit. So once this Z score negative, positive to negativity entered, so it has created a scope. This much of profit it has come. So with a 15 lakhs of turnover. So if you take it 100 lots, 200 lots, based on that the values will change. So these values will go on changing. But one thing here, from negative to positive, here it has come very quickly after within 2 days. But some cases it may continue positive for 5-6 days, then it will come to negative. So it may continue for more than, you can say, 6-7 days or 10 days. So it will, so this tendency will be going on and on. However, one part here happens whenever market hits the top, market hits a bottom. So that time this Z score takes a longer time to rebalance. So what is Z score? Z score is nothing but the demand and supply mismatch, deviation, demand and supply error you can say, or deviation you can say, distribution you can say. That Z score gives you that part of the things in the beforehand. So beforehand it gives you that things, and a real time basis it can be estimated because it is not taking any historic data past 10 days average it is there. However, current spread will be taken from the current data. This spread of current data of August 4 never takes anything from August 13. So if it is August 5, 6, whatever is there, so you can make this thing. So here you can say on I think July, here we enter 21st July, negative was here. So what we did, Nifty we bought, Bank Nifty we sold. So Nifty we bought and Bank Nifty we have sold. So this is the price Nifty bought, this is Bank Nifty has sold. It is spot price, equivalent future price has gone. And if it is a bigger lots, always hedge it. Hedging is very important, so we hedged it. So by this process what happened, though market has reacted, so you can say that in the here the thing says that, so Nifty from 46,085 and 18,936, it has come down to 578 and 491. If you see the difference, 1,68,000, 3,17. So there is a profit is here, but since it is hedged, we have hedged with the 45,000 call, 44,000 put, here to 20,000 put, 19,500 put. So by this process, the hedging has taken a big group, big capital, and it is reduced to some 10,000. But this position need to be hedged. Without hedging, because this buying of 19 lots, selling of 13 lots, this results some 2.5 crores position here. So without hedging, we cannot leave that position. So it is hedging is essential when it is a bigger lot. In case of a smaller lot also it is advisable. Over a period of time, what will happen? Yes, this hedging cost will recover. So you can say here the put option what is being taken 1,42,000 it is given. However, the call option in the Bank Nifty is having a damage of 2,43,000. So that is a 1 lakh rupees damage is there. However, over a period of time, if Nifty goes up from here, Bank Nifty retains here, or Bank Nifty corrects also, what will happen? This 1 lakh, if it is balancing, then Z score will come. That scope is still there. So you have to wait for a level of, because now if we are coming out also, we cannot enter a trade. We require a trade to enter at +2 level. So +2 has not come. Once the +2 level comes, that time we have to close. Whatever may be the things. Say there is no profit comes after hedging, small profit comes, but we have to alter the position. So scope is very, very bright in this, and that also I have shown in multiple occasions how it has worked. So I have given you from 2019 to till now. I have created the test case there. So shown you that what need to be done, what should be bought, what should be sold on this time. If you hedge, what is the profit? Do not hedge. So you are taking bigger risk. Definitely profit will be more. So without hedge, it will definitely the profit will be more. There is no doubt about that. If you are having the single lots, so you can just watch it back test here. His +2 came. I have +2 came here. +2 means Bank Nifty to be bought, Nifty to be sold. Negative means Nifty to be bought, Bank Nifty to be sold. So by this process, you go on evaluating these things, Z score related strategies. You can find it out that it has a great scope, excellent return it will give. This is regarding the Nifty and Bank Nifty. Similar way, those who are using our technical analysis software, this tech analysis software, we gave a Z-score scanner. You can utilize this Z-score not only for the trades, you can utilize Z-score for your investments. You can utilize your Z-score for intradays also. So how? You can say here, stock having more than 1.5 Z score and rising volatility are good for intraday buy trades. Have a look here. Plus Z score of 1.5 and here having a rising volatility. First we filter the stocks rising volatility, falling volatility, no change in volatility. Three groups we have created for the stocks. Stocks having the rising volatility and Z score plus 1.5. So here rising volatility group you got. So here we can say that we can scroll on, find out where 1.565 it has come. So here plus more than 1. So here 2 we have got. So all this here also we got 2. These stocks are good for intraday buy. Then it's blindly do not buy. You see their trend, 1SD trend, Fibonacci trend, anything uptrend breakout given. So that would be good for buying. So similarly, jet stock having more than 60 correlation with rising volatility, good for intraday buy trade. So here we have given the correlation here, correlation 60 and rising volatility. So all these correlations are arranged in this manner. So you can say 60, all these are the stocks having the 60, IndusInd, see that SDFC, Bharati Airtel, India Cement, All these things are having 60 above score. Correlation, rising volatility, good for intraday. So this is also can be utilized as a filter which stock I should make use of, because many of you have this tool also. So those who are having the software, they can make use of that. So having less than 60 correlation give less return as compared to Nifty, less success during the intraday. So short-term investment also you can do. You can do for the intraday also. You can do hedging also, because I have shown you Nifty and Bank Nifty. If you want to that, Nifty and Axis Bank I will do. So here Z score is 1.61. So if you just click on this symbol for 2 times, just take your cursor here and click it for 2 times. What will happen? It will pop off the exact real time. So here I just take the cursor, clicked for 2 times. It will tell, because this is as per Friday's data. Once the market opens, Monday's data will be there. Some junk data will be in our server, that's why it is showing. Monday, once it opens, you will say that this is still Friday. But Monday I am sitting on some time, I want to see what is the Z score. I just have to take the cursor here, mouse pointer, double click, 2 times you click. 2 times quick you click, 2 times you left button of your mouse you click, it will pop up and give you the current Z score. So based on this Z score, you can take a call. You can form a pair trade. We can form, yes, with this rising volatility and minus, it's a falling, you can say it will be, this is plus 1.5. Rising volatility, good for intraday. So if it is minus 1.5, intraday by minus 1.5, then same rising volatility, it will be for selling trade. But falling volatility, that stocks do not take, because falling volatility is a segment where irrespective of Z score, they are going to consolidate. This group of stocks are going to consolidate. Falling volatility. No change in volatility you can accept, because volatility was rising or falling, now it is constant, it is in the same position, you can make it. But here these stocks you can consider, but not this one. But these stocks also have a use. Can anyone will tell me? Any option traders at least tell me what way we can utilize this falling list. These stocks are having falling volatility, what way they can be beneficial to us. Why not take from the bank nifty and banking stocks? You can take. Why not take with the fin nifty with the fan nifty stocks? You can take. So why not take real estate index or all those different indices with their components? You can take. Nothing wrong in that. Nothing wrong in that. So based on your trading scope, you can create it. It is with the nifty we have created this one. With your trading scope, you can create different list for that. But if you compare the nifty and bank nifty combinations, that work wonderfully with the Z score as compared to others. Nifty and bank nifty combinations are more successful, maintains more than 90% success in Z score trade. And this, those who have taken in those guided programs and all, I have shown them that how big position I used to personally initiate in this. Huge position I initiate in this. And you can take also huge position. So take with the hedgings, nothing is going to happen. Confidently you can take this. Z score is a demand supply mismatch, market has to accept it. There is no other go. Your mutual funds, FIs, whatever are there, Z score, beta decoupling, they cannot defy. Why they cannot defy? You must tell me. It is mathematically you are understanding their accumulation and distribution pattern. They can accumulate one particular stock or one particular sector for a period of time. They cannot buy only one sector for 5 years, and they will go on selling other sector for 5 years. So this Z score, beta decoupling are such kind of methods. It is not mean revision, Dinesh. So Z score and Z-score based positions, beta decoupling related position. Beta decoupling is my own innovation from 2005. It is Smart Finance, Mr. Ranjan's innovation. No one else has authored it. It is my copyrighted innovation. Z-score is not mine. Z-score I modeled it. However, beta decoupling is mine. Sector decoupling you have. Index decoupling you have. Those are the methods, are never failed methods of pair trade. Very high success rate, but it will test your patience sometime. You need, your waiting period may increase sometime, but it will not disappoint you anytime. So that is there, and the power of these methods are wonderful. It can, if you start doing with the Z-score, it has the ability to develop your capital in 1 to 1.5 years time. That is a great thing. You cannot achieve in any kind of investment or anything. So that is the power. But the way it looks simple, it is not that simple. Why? If you take bigger positions, you have to hedge very aggressively. Very aggressively you have to hedge. You need to count how much time value you are giving, how much time value you are getting. All these things you need to count. You have to go for a profit capping also. So these are the things you have to get. So this is a separate tool. I think all of you will be having. Those who are having this tool, you can utilize it. Those who have taken our full package, they will be having this particular tool. So this is a tool we have given. So in this we have given this is Z-score. Clearly given the next here, when you should invest. Positional, I am telling you. It is not intraday. These are Z-scores are not intraday. These are the position you have to take. Wait for the Z-score to go opposite. If you have entered at +2, you have to wait for -2. If you are entered at -2, you have to wait for +2. Then only your profit will be optimized. If you want to invest in, so what is saying? 60% correlation, rising volatility, good for intraday. 60% correlation, falling volatility, good for short-term investment. Here also say that stock having more than plus Z-score, falling volatility, good for short-term investment. So these also you can utilize for the investment, pair trade, short straddle, short strangle related things. Many different ways you can utilize this method. Are unshakable. Any big thing happens, let it fall by 5,000 point, goes up by 5,000 point. If you are hedged, you will enjoy this trade. Process says that I do not want to learn anything new. I am intraday trader. I will remain intraday trader. I will die as an intraday trader. So then there is no point of this method. You follow television channel model. This is a pair trade model. This cannot be done. Only Bank Nifty I will buy. Why? That doesn't say that Bank Nifty is cheap now or that is costly now. Both will react. So this -2 doesn't suggest you here only Bank Nifty will fall, means Nifty will rise, Bank Nifty will not fall. Here one question came, very important question. So some participant asked, in this stage when it is negative, why should I sell Bank Nifty? I can buy Nifty here and wait only this one. Did this method says only Nifty will rise and this will sit here, it will not fall or it will not rise? That I have never uttered. You do not know which side is going to balance. That's why two positions. Pair trade is what? Balancing of this demand and supply mismatch can happen in either way. Means Nifty can go up very fast, Bank Nifty can go up very slow. That is one alternative. Nifty goes up, Bank Nifty fall back. That is another alternative. Nifty fall less, Bank Nifty fall more. That is another alternative. So 6 alternative will come. Which alternative is going to work out for you? How you will know? So both pair trade say that these alternatives are, any alternative comes, I should be benefited. That is why pair trade. That is why option trade. Any alternative comes, any situation unfolds, I should make money. That is why hedging. That is why fair trade. That is why you are doing all these things. Otherwise, it is a very simple game. Buy this, forget it. Then why the hell you will read this? What is the point of reading all this mathematical stuffs working for so many hours? And ease of doing, whatever we are saying, ease of doing, happiness, prosperity, good sleep after taking crores of rupees position also, then that is not a trade. That is a tension. That you cannot say trade. That is, by paying the money, we are buying the tension. Okay, so that should not be. You need what? Comfort. You need trade should be smooth. You need to understand the physiology of the market. You need to understand mathematically how majority of traders are thinking about Nifty and Bank Nifty. That is Z score. That is beta decoupling. Peacefully, you have crores of rupees of positions. You can sleep nicely. I had huge positions opened. Last Friday, went to the Hyderabad, met with my good friend and came back. No tension, not even open of the position. I am not worried. Why? Because I take Z score, I take beta decoupling, I take option strategy. 5 days if I have fever, I am sleeping also, I am not worried. Screenshot Deepakji what you have seen here. I sold Bank Nifty quantity 19 lots. I bought Nifty quantity 13 lots. Though future was giving me the profit, but my option hedging positions was landing me in the losses. Here 1,42,000, 2,43,000. So here out of this 2,43,000, I closed this position, taken 1,42,000 out. That means my liability stands at here 1 lakh. And here again I have reinvested on 235, another 2 lakhs. So you can say that this also can become a liability. So for that, some time value to reduce, I sold this put options of 500 and same, not 34 lots, this is 19 lots. So 19 lots it is being sold out. So 19 lots it is being sold out. So it is going to give us some profit. So time value was 400 rupees. I am taking out that 400 rupees out, so that if the fall continue, I will make some money. If fall doesn't continue, trend reverses, I will make the profit. So by this process, it is a complex hedging techniques. Once you practice more, these are the things will come. So this is at this stage, the when you learn this thing, you go with a simple model, simple hedgings. Then once you mature in that model, then you can go with the complex hedgings based on the size of position, based on what kind of size is there. It is a 3.5 crore bought, 3.5 crore sold. So big position. So that's why little bit of things also we need to cushion it.